Hello, everyone. Today on the final bar, I'm talking to Todd Sohn from Strategas Research Partners in New York. We'll talk about this market. Certainly a choppy, uncertain day among choppy, uncertain times. We have the S&P, the Nasdaq selling off through the course of the day yesterday. The gap down this morning, but aggressively moving to the upside with the Nasdaq Composite up 3.5% almost. So, what does this mean? The short-term rally in tech communications names versus the long-term. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close for our show as we break down the market activity using the power of stock charts, using the technical analysis toolkit to better quantify investor behavior and better trying to understand what is happening around us. These are crazy times as a market participant and talking to a number of my peers in the industry over recent weeks and months. These are in some ways unprecedented times, but in a lot of ways, they're rhymes with other periods of market dislocation, other periods of uncertainty, where you have bear market rallies, where you have counter trend moves, where you have significant shifts very quickly and elevated volatility. And that overall is what we're seeing now. And that is very classic for what we've seen coming off of all-time highs and trying to navigate this fine line between a corrective period and a bear market phase and trying to make sense of how this relates to the long-term trends. I'm going to talk to Todd Sohn from Strategas in a little bit. We'll focus on the overall environment and also one particular sector that he wanted to highlight for us that may have some questionable upside. And overall, later today, we'll talk about the sentiment readings and look at some of the market sentiment measurements. AAII Survey. Now, the spread between bulls and bears is the most severe it has been in a long time. I'll share with you the last time the spread has been this big. We have great guests on the show. Todd Sohn from Strategas joining us here in a few moments. Next week, two guests to highlight for you. Craig Johnson from Piper Sandler in Minneapolis, and then also John Gagliardi from Fidelity joining us for the first time. John actually works with a number of their financial advisors and works with traders on the Fidelity platform. So we're interested to see what sort of themes he's picking up working with their advisors and their clients. Also, our latest episode of The Pitch is coming up tomorrow. Grayson Rose here at StockCharts.com is going to moderate a conversation with three fantastic guest experts. They will each share with you five stock ideas or ETF ideas, and they'll debate them as a group. It's a lot of fun. I've moderated that special many, many times. So go to StockCharts.com/the pitch for more info on that event. Let's get to our market recap today, sponsored by Tradier Brokerage. If you go to Stock Charts ACP in the lower right corner, you'll see a little arrow aiming up and to the right. That's the Tradier symbol. You can trade live from StockCharts.com ACP using Tradier Brokerage. For our market recap, let's talk about the S&P and this rally that we've seen, opening lower, closing higher. And we'll look at what the chart actually played out really close to a what's called a bullish piercing line, which may be getting down there on the list of your candlestick analysis familiarity. But I'll share with you what that means. It's sort of like a bullish engulfing pattern that doesn't make it all the way up, but goes at least halfway up through the range of the previous day. It's pretty close to doing that on the S&P and certainly the Nasdaq. We'll look at those charts together here and see if we can declare that as the case. But certainly a nice recovery. I mean, obviously a lot has happened in the last 24 hours. We've had this build up to hostilities in the Ukraine and bubbled up and sort of exploded last night. Earlier in the day, the market opening lower, a lot of things selling off very quickly, but through the course of the day, really pushing back to the upside. So technology up 3.4%, the XLK, the Nasdaq 100 up 3.4% as well. Those are nice bounces off of some fairly beaten down levels, but I have to think about the longer term where the Nasdaq 100 has broken below 14,000 and it's still below there. So even with the rally that you saw today, this is still failing to eclipse a very key support level that has recently been broken. Mid caps and small caps up as well, and they sort of split the difference between the S&P in the middle up about 1.5%. On the fixed income side, you had sort of a lot of movement, to be honest with you. And earlier in the day, you had bonds opening pretty high as sort of a big risk off move, right? So you had bonds higher, stocks lower through the course of the day. That essentially reversed, and so interest rates rallied through the course of the day, came higher. The 10-year yield finished the day around 197. This was after opening the day down around 187. So a nice drop in bonds as equities rotated back to the upside. Gold was higher through the course of the day, but broke down in the midpoint of the day. The GLD finished down 0.6%, silver down 1.9%, and that is certainly a change of character from what we've seen up until today, where gold prices have been really breaking out to the upside and rotating higher. Cryptocurrencies really rallying in the last couple of hours as well, with Bitcoin around 38,400 and Ether just below 2650, up 2.5% from yesterday. Looking at a chart of the S&P 500. So when I talk about a what's called a bullish piercing line, I'll show you very quickly what that candle looks like. And this chart here makes it a little obvious. So if you know candlesticks, right, the body of the candle gives you the open and the close. The wick or the shadow gives you the high and the low for the day. Yesterday, you had this big down candle where we opened here at 43.25, closed around 42.25. We opened just above 41.50, traded lower, but by the close, we got at least 50% of the way through the previous day's real body. That candle pattern, that two-bar pattern, is called a bullish piercing line, and it is in fact a bullish candle. It tells you the next couple bars are most likely higher rather than lower. And talking with Steve Nissen years ago about candlestick analysis, one thing he told me that I never forgot was when you have a two-bar pattern like that, you have the short-term direction, so it's telling you short-term bullish, but you take the low of that two-bar pattern, which is just around 41.20, we'll call it, which is today's low. That's the natural stop for that pattern. So you assume the trend is going to bounce from here, but a break below there would invalidate today's bullish candle pattern and suggest potential downside. So what we're seeing now, if you have the close, let's see, the low close was back here in late January. We now have yesterday's close here, just around 42.20, 42.30. We're starting to form what could be a bullish momentum divergence with the closing prices going lower, the RSI actually sloping higher. So we're oversold on that first lower close. We're not oversold on yesterday's close. It certainly looked earlier today like we are going to blow right through that oversold region. But given the rally that you saw today, it's completely changed the character of this chart. Today is a great example of the issue that I share with you a number of times about putting too much weight on the current bar, the current candle. Remember, that's an active candle. So as the day goes on, things can move very, very quickly, just as you saw today, right? Earlier in the day, the whole market had a certain feel to it, with the RSI becoming oversold, with it starting to look like a big move to the downside. All of a sudden, you recovered quite a bit. And I can't say, with absolute certainty that we don't just revert right back to the downside and undercut today's lows, for example. But I would tell you the fact that we have changed quite a bit and are still not oversold for this pullback is something to pay attention to. I would assume, I think the key is, do we break 4,200? That's this level right here. That's a Fibonacci support level. Looking at the last year and a half or so, we've sort of bounced off of that range in January. We've now traded down to it, closed at the range. We opened below there, but now have closed back above it. So I would have to say that until 4,200 is broken, that's what would open the way to further downside. I would put a downside objective around 3,800, which would be the 61.8% retracement of this move. But as I mentioned many times, there's nothing more painfully bullish than a bear market rally. Things go to the upside, revert to the upside very quickly. They are super seductive, and even with the move we've seen to the upside today, I would still consider this as a bounce, still within a downtrend. I think the market has a lot to prove before you feel really optimistic about things. Now, on the sector basis, you have technology, communication services, consumer discretionary, 1, 2, 3. Certainly more of a risk on feel by the end of the day. On the downside, you have consumer staples, which has been outperforming consumer discretionary for the last couple months. Financials, number 2, and I'm excited to talk to Todd Sohn about that particular sector and what may be in store. And then the energy sector, and energy obviously is sort of the upside outlier. This is the sector that's had the best returns so far year to date. And it would be hard to argue with energy having at the very least some sort of pullback given the strength that you've seen. And even with the down move that you saw today, about 0.8% overall, that's a trend that's still very much in play. That's still a fairly strong trend. Just want to finish off here with a chart or two if we could. When you look at the breadth conditions, they've certainly rotated to the downside. And this is not updated for today's close. I would expect all four of these to bounce back to the upside. But as of yesterday's close, as of Wednesday's close, you can see how all four of these have sort of violated their recent swing lows. The common stock only NYSE advanced decline line made a new low really in late January, and now has continued to make a new swing low. The same with the small cap breadth, the advanced decline line, which undercut the December lows in January and now have undercut those again in February. The mid cap 80 line really just followed through to the downside yesterday, although again, today we'll probably see that bounce up quite a bit. It's fascinating to me that the S&P 80 line is right at its December lows. It'll bounce off today, given the strength that you saw in the offense within the S&P 500, the mega cap leadership. But overall, this is a breadth picture that has turned from positive to really sideways or stagnating to now more negative. And this divergence that you saw here in November and December, when I talk about how I think the top in a lot of ways happened in November. Charts like this are what tell that story very well. With half of these AD lines making a new low, or a lower high in early January, while the S&P and the AD lines actually made a higher high. We need to take a quick commercial break. We'll be back with today's guest, Todd Sohn. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We really appreciate you joining us every weekday after the close as we break down the market environment using stock charts, using the technical analysis toolkit to better identify trends, master momentum, and focus on where the opportunities may lie. A couple quick announcements before we get to today's guest, Todd Sohn from Strategas. First off, we welcome your questions. We're going to do a mailbag segment on tomorrow's show on Friday, and we would love to feature one of your questions on the air. You can email us your questions at thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That's our on-demand platform. It is completely free. Use your email address. You can set up an account, start watching all of our great content on demand. Guest appearances like Todd Sohn and other knowledgeable analysts and strategists and traders. Also special events like The Pitch, Larry Williams' Market Outlook that was out in January, and his follow-up, which is just out in the last week, and so much more. Go to StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. I want to welcome on today's guest, Todd Sohn. Todd is the technical analyst at Strategas Research Partners, coming to us from New York. Todd, Happy New Year. Good to see you, and welcome back to the show.
Hey, you too, Dave. Thanks for having me on.
So obviously, a lot of uncertainty in the recent months, but especially in the last 48 hours, we've seen sort of been a tale of two markets. The sell-off yesterday, a bit of a recovery today after gapping down at the open. What are you seeing as you look at 2022 so far? What is telling the story for you?
Yeah, and I think referring to the first chart we have here, one of our favorite exercises is to look at where are investors, traders, participants in the market, where are they allocating their dollars towards, right? And what stood out to us since the S&P has started this correction almost 2 months ago now, they have swarmed towards value, they have swarmed towards financials, commodities, right? These real asset type of plays. And they've been right? That is where the relative strength has been throughout the last few months. And then conversely, at the bottom of this chart, you can see there's been outflows from the growth factor because those stocks have been absolutely clobbered recently. What I think is interesting, though, and this was reflected today, is that when you start to get this herding behavior, my contrarian antenna goes up, right? Our flows and is sentiment towards value and financials getting too aggressive. And I think that's what's unfolding right now, at least in the short term. You mentioned the Qs had a huge rally reversal today. You saw the most beaten down type of names rally from significant oversold conditions. And so I wonder, in the next couple of weeks, are we going to get some sort of reversal trade where you see growth work and the value and financial type of areas cool off, and perhaps start to see outflows too from those funds. I think this is helpful data in determining, some near-term sentiment moves.
It's really interesting. So this is looking at year-to-date flows in and out of some of these ETFs, and it's clear sort of a value over growth mentality. Your second chart, you mentioned financials being one area that you might see some downside. What's talk us through this chart of the banks index?
Right. So again, a lot of flows into financials, right? So the contrarian viewpoints coming into here. I don't like to see that run too hot. And then secondly, while this is still a good trend, if the action we saw today is to continue, you saw banks and financials weak, energy was weaker, whereas tech and growth are stronger. That would suggest to me that those names rally, and the overbought banks, the energy names, they can come in here a little bit further. The most important thing though is the banks are not anywhere near oversold conditions. And if they continue to contract, it is essential that they hold the highs there from 2018. And if you even went further back on this chart, back to around 2007, that's an important structural level for the banks. I think we all celebrated over the last 2 years when they finally broke out. If they fail to hold that, there's about a good 10% leeway between these levels and where that support is. I would suspect they would bounce, but if they fail to hold that for whatever reason, then things are going to get really rocky for the overall market. But I don't think that's our base case here. But just trying to put down some risk that, yeah, the banks may have a little more downside, but they do have very, very important and major support below them for now. Something to keep in mind
It's
here.
such an interesting chart. This is the BKX, and you can see I mean, just in the last 6 months, you can see the uptrend in price and then the lower momentum characteristics right along the way.
Right.
When Todd, when you're looking at the S&P 500, obviously it's been sort of a crazy day. The chart has fluctuated rapidly depending on what point of the day you brought it up. But when you're looking at the S&P, I mean, what key levels or what key signals for you would confirm the fact that we are not done and that we have further downside? Is there a risk level or a line in the sand that you would say, all right, we really need to start getting more defensive than we've been up until now?
So I think in terms of a level, it looks like we covered it today. The January 24th low was at
Mhm.
42.25 or so. Very, very tactical. But what's going to help us determine how this rally looks is breadth, right? How many stocks are in on the move? Leadership, is it risk seeking? Is discretionary outperforming staples? Is high beta working? And what does credit do? Credit spreads have widened out
Mhm.
here over the last few weeks. What you don't want to see is an equity rally back towards, say, 4,500 with widening credit spreads. That is a major red flag, and it's just telling us that some folks have stepped in to buy stocks, but there is underlying credit deterioration going on, and that's when you get some serious problems. And that would leave me very hesitant to want to really commit to any sort of rally. So again, breadth, leadership, and credit. Those are the three main tenets that I think are becoming very important here in the next couple of weeks.
That's a great way to summarize it, Todd. And I appreciate you sharing credit spreads. I often found with particularly individual investors, they tend to not think enough about the credit markets and the color they can provide on what's happening underneath the hood as stocks are on the move. Listen, Todd, it's awesome to have you on the show. Really appreciate you giving us some time today. Stay safe there in New York. We'll talk to you again soon.
Thanks, Dave. Appreciate it very much. Take care.
That's Todd Sohn. Todd's the technical analyst at Strategas Research Partners in New York. And if you caught what he said at the end, I thought that was fantastic. What a great summary for how to make sense of this sort of tactical bounce that we've seen just in the last 48 hours, sort of a quick reversal with growth leading back on the upside. It was all about breadth, it was about leadership and credit spreads. We'll try to talk more about that as he's doing that. I'm mentally jotting down. I need to talk more about credit spreads on the show, and I'll try to make a point of doing so because it tells you about sort of the nature, what is the underlying theme behind the markets, and anyone that I've ever worked with who has a background in the fixed income markets often does such a great job of thinking more about risk rather than potential risk versus potential return. Steve Sutmeyer at B of A comes to mind as someone who started as a fixed income analyst, goes into equities, and always has a great sense of the risk characteristics because of that. Great take there from Todd Sohn at Strategas. We need to continue today's show and go to our next segment, Getting Sentimental. About once a week, we like to visit the sentiment indicators. We break down sentiment in three sort of main areas. I look at volatility first. We'll look at the VIX, look at some survey data. So we have the AAII survey and the name exposure index. Then we'll look at the put call ratios, which is basically looking at options data and determining where the bets are being placed. And all of these, I would argue, help you to qualify or validate what you're seeing with price. I tend to think of price, breadth, and sentiment in that priority order. It starts with price. Second is breadth. What can the breadth conditions tell you about participation or the stocks that make up those major indexes? And then the third one is sentiments, or what are people saying with some of their positioning data, but also how are they voting with their in the surveys, or what are they saying and what are they doing with their capital, and using that to validate what you're seeing with price movements. We'll start with the VIX, and the VIX in the last couple of days has settled in right around 30. This is where the VIX reached actually in early December of last year. In late January of this year is just above the current levels, and then where we're at around 30. So far in the last 3 or 4 months, this has been kind of where these buyable dips have been. Now, again, there's a difference between buyable dips that we saw back in the bulk of 2021 and honestly much of 2020 versus the buyable dip that we saw in January, right? Which is more of a bear market rally. The chart's in distribution mode. You get a quick, sudden move higher after a sell-off. I would argue if we do get a rally here, that's how I'm gonna want to classify it. Until the character of the chart very much changes, and particularly the breadth. I think Todd's comments about breadth characteristics are super accurate, and I would argue we really haven't seen breadth materialize yet in a way that would make me super encouraged about it. We'll see what today's data does to some of the breadth indicators we watch. But in terms of volatility, two things I would know. Number one, the overall level of volatility is higher. We've talked about elevated volatility, elevated uncertainty, and that's what we're finding, which means expect whipsaws, bigger swings in stocks and your portfolio. That's sort of the general environment that we're in. Uncertainty means volatility, or volatility means uncertainty, maybe a better way to say that. The second is we are at that point where we've been the last couple of times we had a pullback in early December, in late January, and then where we are now. When the VIX gets above 30, that's tended to be a good time to look for an upside bounce. I'll be very interested to see if that is sort of the new level. At times we've had other levels. 25 was a level, for much of 2021. Is this sort of the new ceiling for the VIX? Let's wait and see what we can see. Chart number 2 is the AAII Survey. This is the American Association of Individual Investors. This is basically surveying a couple hundred group of investors every week and asking, are you bullish, bearish, or neutral on stocks for the next 6 months? And this is where the numbers came out. In terms of bulls, a little higher than last week. We're back pushing above 20% to 2340. This is an interesting one, though. Over 50% bears, which is actually pretty unusual. If you look back in the history of the AAII survey, not often that you get bearish readings above 50%. It tends to be much more obviously in bearish trends. That's when you get sort of an acceleration in bearish sentiment. What's really interesting is if you look at the spread between those two, it's now a 30% swing of bears over bulls, and bears outnumber bulls by almost a 2-to-1 ratio right now. Actually, a little more, about 2.5 to 1, right? So what's interesting is that spread between the two has not happened very often. You have to go back to 2013 for the last time the spread between the bulls and bears has been this wide. And before there, you're going back to, I think, 2010 and then a bunch in 2008. This is as the markets were topping out and then pushing to the downside in an extended stretch of time where the spread between bulls and bears consistently hit over 30%. So it's interesting right now as we're getting to some really bombed out sentiment readings. Does not get down here that often. And for me, indicates certainly a beginning of a belief phase, maybe that the market is deteriorating and has further downside potential. The name exposure index is an interesting one as well. The current reading is around 44%. This is a survey of money managers, active investment managers, and what their allocation is to equities. This is basically saying on average there's a 44% long allocation to equities. I don't think this indicator has ever gone below 0% equity. I may be wrong, but going back in the history, I don't believe so. It got really close in March of 2020 when it got down to about 5-10%. but hasn't gone below zero. So when you look at the current level, it's sort of this blue area. You can see the last time we were this low was in May of 2021. Before there, you have to go back to some pretty deep pullback periods. You're going back to February, March of 2020. You're going back to late 2018, which is sort of a significant drop. You're going back to mid 2015 and late 2015. And what's interesting is in every one of those other scenarios, as the name exposure index got below its current levels, you can see that those were the four sort of more significant, more drawn out corrective patterns. When you had that initial reading of around below 50%, it wasn't the end of that correction, right? It was sort of in the beginning stages of that. You had a lot more downside in terms of price, and certainly a lot more time before you could have declared a recovery period after that corrective pattern. That's one of the many pieces of evidence that suggests to me that we're still potentially in the early innings, or certainly not at the later innings of an overall corrective period for the equity markets. Last indicator I just want to highlight is the put call ratios. We look at two of those: the total put call ratio, which includes index options, and then the equity put call ratio. And if you're not familiar with put call ratios, by the way, for any of these indicators that I'm showing, if you click on our Chart School tab, type in put call ratio, you see some Chart School articles, some blog posts that talk about these indicators and give you examples about how to interpret them. But I'll just finish this segment on sentiment by pointing out that the average, I look at a 5-day average of the put call ratio because it's a daily indicator that's pretty noisy. That's in the background in gray. The 5-day average is really at the upper ranges of where it's been for the last 18 months. This is going back to February, March of 2020 when you really spiked above those levels. So what I'm doing now is trying to look back in history and see how this current move relates to previous corrective periods versus buyable dips, versus things that are more short term and started to turn higher and started to rally. What's interesting about the February, March 2020 is you really accelerated above the current level, spiked well above here on the put call ratio. We've not necessarily seen that yet. When you look at equities only, same thing. You're sort of in the last couple of weeks, you've been at the highest levels we've seen since spring of 2020. So definitely at the higher end of this range, and sort of lining up more with some of the deeper corrections, but not spiking as high as some of those previous periods. There's certainly more upside to be had in those indicators to indicate more bearish sentiment. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is new Dow theory. We highlighted this, I think, last week. It's a bit of a blur here given all the market craziness. But the S&P and the Nasdaq Composite is looking at two key areas of the market and seeing where you have agreement. And agreement means both of them breaking out to the upside or both of them breaking down through support levels. In September, October, November of last year, you can see why the indicator was sort of long and strong, both of them breaking to new highs. That's a thumbs up. You had what's called a non-confirmation here in November, December of last year, as the S&P made a new closing high and the Nasdaq Composite did not. Now you have a bearish confirmation where the S&P has closed below 43, call it 4250, 4300, actually, I want to say is the close from October. We touched that there in January and now closing below that level. The Nasdaq Composite had done that quite a bit ago, getting below 14,200 or so. So at this point, I would argue that the new Dow theory is more negative and confirming a broader decline in stocks. The New York Stock Exchange Composite Index is what we'll look at next, $NYA. I actually got a question about this from a viewer earlier this week, asking why we don't look at the New York Composite Index too often. And it's a fine index. It's a broader index. It's sort of like the Russell 2000, but obviously for a lot more larger names. But it includes a lot of smaller, mid cap, small cap, and even some micro cap types of names. Although not a ton in this index. It's more large, mid, and small. But basically, it's a broader universe of stocks. The reason why we don't talk about it so much is there's not a lot of passive investment tied to the New York Composite as much as sort of like the S&P, the Nasdaq, and some of those cap-weighted indexes we talk about more often. The New York Composite is a broader universe, and as you can see, it's been in more of a basing pattern for quite some time. Earlier today, this looked like a huge, valid, absolutely key breakdown through support. by the end of the day, it's looking not quite so valid and not so severe. It feels like we opened lower traded lower, but then closed right back at that breakdown level. So I think that support level is still one to watch. That's right at 16,000 for the New York Stock Exchange Composite Index. I would pay attention to that. Finally, I mentioned the bullish piercing line on the S&P. Check the chart of Microsoft with a bullish engulfing pattern. That's a short-term bullish pattern, and watch the low of today for a stop on that natural rally. That suggests for Microsoft, upside to be had here in the short term. Folks, that's our show for today. Special thank you to Todd Sohn from Strategas Research Partners joining us from New York. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.